I am going to talk to you as if you and I are sitting at the same kitchen table. I am Warren Buffett, and I want you to hear this the way I think about any business. Remove fragility first, then let compounding do the heavy lifting. No speeches, no hype, just a plan. And yes, I am going to speak in the first person, because the lesson is personal. I am going to give you a lens that will change the way you see money. Think of your financial life as a casino. When it is small and underpowered, every wave matters. When it is strong and well supplied, storms are still storms, but they do not sink you. The difference is game theory. People love to argue about whether you are rich because you earn more or because you invest better. That argument misses the first battle. The first battle is stability. If you are unstable, you cannot think long term. You cannot negotiate well. You cannot wait for the right pitch. You swing at bad pitches because you have to. When your bank account is near zero, you do not just have less money, you have less bandwidth. The small emergencies become big, the small fees become heavy, the stress becomes constant. That is why I call it the physics of poverty. It behaves like a force that keeps you in the same orbit. The goal is not to feel motivated for a week. The goal is to reach house edge. Once you cross that line, progress gets easier. Before you cross it, everything feels harder than it should. I will walk you through the 5 chains that keep people stuck. Then I will show you the 3 stages that break those chains. None of it requires genius. It requires a plan and the willingness to protect that plan from a world that profits from your distraction. Section 1. The scarcity tax. Let me show you how the scarcity tax works in a normal week. Your car makes a sound. You know it needs attention, but you are short this month. So you wait 2 weeks later, the repair is bigger. The small problem becomes a big invoice. The tax was not only money, the tax was delay. Banks understand this. That is why overdraft fees exist. The fee is not priced to cover a cost. It is priced because they can. If you are stable, you avoid it. If you are unstable, it hits you when you are weakest. Insurance works the same way. People who are short often choose the plan with the highest deductible because the monthly payment looks smaller. Then, when the event happens, they cannot cover the deductible and the whole situation becomes a crisis. The scarcity tax shows up again. In business, I would call this undercapitalization. The fix is not shame. The fix is capitalization. Even a small buffer is capitalization for a household. Now, let me give you the counter move. When you build even a small cash cushion, you start buying time. Time is what turns emergencies into scheduled maintenance. Scheduled maintenance is cheaper. It is calmer. It prevents the cascade. If you do not know where to start with the next predictable expense. Tires, annual insurance, back to school, holidays, travel. Those expenses are not surprises. They are only surprises because the money was not parked for them. So you create a sinking fund, $10 a week, $20 a week, whatever you can do. The point is to stop being surprised by the calendar. Once you stop being surprised, you stop paying the penalty rates that come from panic. There is also a psychological scarcity tax. When you are short, every choice feels like a threat. That stress changes your behavior. You snap at people, you avoid paperwork, you delay decisions. Those delays create more fees and missed opportunities. So part of survival is making money boring. Boring is good. Boring means your bills are on auto pay. Boring means your paycheck is already assigned jobs. Boring means you do not wake up to surprises. When you hear someone say, "I make decent money, but I feel broke," often what they mean is that money is still chaotic. Chaos feels like scarcity, even when income is higher. Order is wealth in its earliest form. Owner lens. When I run a business, I remove fragility first. I build cash reserves. I reduce fixed costs. I diversify customers. The household version is the same. Remove fragility before chasing returns. Section 2. The dopamine trap. The dopamine trap is not about bad people. It is about tired people. If you have been stressed all day, your brain wants a reward. The internet offers a reward in seconds. It is engineered to do that. So if you only tell yourself, I must stop spending, you are fighting a chemical system with a moral slogan that usually fails at night when you are tired and alone and your phone is in your hand. A better move is substitution. Replace the cheap dopamine with a reward that does not sabotage you. I used to get my reward from learning, from watching a balance sheet make sense, from seeing a small investment grow. It felt good because it moved me forward. Your reward can be different, but it must move you forward. If it moves you backward, it is not relief. It is a loan with interest. Here is a small rule that saves people. The 24-hour rule. If you want something that is not necessary, you write it down and you wait 24 hours. If you still want it, you save for it. Most impulse spending dies in that window. Another rule is the one-click rule. You remove one-click buying. You remove saved cards. You make yourself type the numbers. That friction is not inconvenience, it is protection. The richest people I know are not the people who never want things. They are the people who can wait. Waiting is a superpower in markets and in life. The dopamine trap also shows up in investing. People chase excitement. They chase the story stock. They chase the quick flip. That is the same impulse in a new costume. If you are serious about freedom, you make your investing boring, broad index, long time horizon, regular contributions. That is how you stop gambling with your future. The market rewards patience. The shopping cart punishes it. Choose which system you want to live in. Owner lens: if you cannot control your attention, you cannot control your money. Attention is the upstream variable. Protect it like an asset. Section 3, the linear income trap. The linear income trap feels safe because, the rule: work more, earn more. But it is fragile because one illness, one layoff, one family emergency can break the line. When I evaluate a business, I look for resilience. How many ways can it earn? How many customers? How many products? How much pricing power? Your household needs the same thought. A second stream of income does not need to be huge. It needs to exist. It is a spare tire. You do not appreciate a spare tire until the main tire blows. Leverage begins with skills that travel. Skills that are valuable in many places. If your only skill is tied to one company, you are negotiating from weakness. If your skills are portable, you can walk away. Walking away is the source of leverage. Pick a skill that increases your value per each hour. Then practice it every day for 90 days. Not when you feel inspired, every day. The compounding of skill is real and it is underpriced because it is quiet. When your income rises, you do not upgrade your whole lifestyle, you upgrade your investing. That is how income growth turns into wealth instead of new bills. Ownership is the cleanest leverage. You can own a business, you can own a rental property, you can own a piece of thousands of businesses through an index fund. The form matters less than the fact that you own. The moment you own, you are no longer only labor, you are capital. Capital has different rules. Capital can earn without hours. That is why the wealthy protect capital so aggressively. If you have never owned anything, start small. You are building identity first. Owner lens: your income is a product. Your skills are the factory. If the factory is outdated, the product will never compete. Invest in the factory. Section 4. Social gravity. Social gravity is sneaky because it does not announce itself. It looks like jokes. It looks like you only live once. It looks like it looks like, come on, everyone is doing it. But in aggregate, those moments are expensive. They turn your plan into a suggestion instead of a rule. So you practice scripts. You say, I am on a plan right now. I can do coffee, but not dinner. I can come. But I am not ordering drinks. You do not need to explain. You just need to be consistent. If you are married or in a partnership, money becomes a relationship problem if you do not talk. Talk early. Talk often. Agree on the rules. Agree on the goal. Otherwise, you will drift. And drift always follows the gravity of consumption. One of the best investments is a household that is aligned. Two people pulling in the same direction create a flywheel that is hard to stop. If you are alone, you still need accountability. A friend, a group, a coach, or a weekly check. In with yourself that is honest. I learned early that I did not want to compete in a lifestyle contest. Lifestyle contests never end. There is always someone with a bigger house or a newer car. The only way to win is not to play. When you stop playing, you free money for ownership. That choice can look boring to other people. Boring is fine. Boring is rich. Build a circle where boring is respected. Owner lens, culture beats strategy. The culture around you will either reinforce discipline or sabotage it. Choose culture on purpose. Section 5, the compound void. The compound void is the most tragic one because it is invisible. If you do not invest at 20, you do not feel pain at 21. You feel it at 45. The bill arrives decades later. That delayed bill is why people ignore it. Humans react to pain they can see. Compounding is pain you cannot see until it is late. So you make it visible with a scoreboard. Track your net worth monthly, even if it is negative. Watching the number improve is motivating, and motivation helps you persist. A simple formula changes lives. Invest first, then spend what remains. Most people do it backward. They spend first, then invest what remains, which is usually nothing. If you want to make it automatic, you treat investing like a bill. You do not debate bills every month. You just pay them. Pay your future self the same way. The amount can be small. The consistency is not negotiable. People ask me, what should I buy? They want a magic ticket. Most of them need a system, not a ticket. A low-cost broad market index fund is a system. It captures the long-term growth of productive businesses. It is diversified. It is simple. It is hard to sabotage if you automate it. If you cannot invest much yet, invest in lowering your cost of living and raising your earning power. Those are also compounding investments. Owner lens, compounding is not a trick. It is what happens when a small advantage is applied consistently. Make ownership the default. Section 6. The 3 stages that change your life. I promised 3 stages, and I want you to see how they map directly to the 5 chains. Stage 1. Survival breaks the scarcity tax by creating order and a buffer. It also weakens the dopamine trap because stress decreases when bills are under control. Stage 2. Accumulation breaks the linear income trap by increasing earning power and creating a gap. It also weakens social gravity because you start choosing your environment more intentionally. Stage 3. Freedom fills the compound void because your investing becomes meaningful and steady. At that point, you are not chasing the future. You are building it. Let me expand each stage with actions you can take, because actions are what change the math. Survival actions. Won't create a cash snapshot. Do not guess. Print your last 90 days of statements and highlight every non-essential purchase. The goal is not guilt. The goal is clarity too. Stop the fee machine. Turn on alerts. Put bills on autopay for at least the minimum. If you cannot call and renegotiate due dates, fees are a tax you can often avoid with systems. 3. Stabilize food and transport. If you can control those 2, you can control a large chunk of the monthly chaos. Simple meals, simple routines. This is temporary and it works. 4. Build the first buffer, even if it is small. I would rather you save $5 consistently than promise yourself 50 and quit. 5. Choose 1 debt to attack, not 5. 1. Finish it. Finishing changes identity. Accumulation actions won't build the gap. Every wealth plan is built on a gap. If there is no gap, there is no investing. And without investing, freedom stays a fantasy. 2. Raise income strategically. The fastest income gains often come from switching roles or switching employers, not from working harder for the same employer. That is not disloyalty. That is market reality. 3. Add a side stream that fits your life. It can be tutoring, a service business, freelancing, selling a digital product, driving, repairing, consulting, or anything that produces cash without destroying your health. 4. Do not let new income turn into new lifestyle. If you do, you are on a treadmill. Put at least half of every raise into debt payoff and investing until you reach stability. 5. Keep the system simple. Complexity is the friend of procrastination. Freedom actions. Zone, automate investing, so you do not rely on motivation. Motivation is a weather pattern. Automation is climate. 2. Build a long-term portfolio. You can hold through storms. A broad index fund held for decades has made many ordinary people wealthy. You do not need to outsmart everyone. You need to outlast your own impulses. 3. Protect your downside. Keep emergency reserves. Carry adequate insurance. Avoid leverage you cannot survive. Freedom is fragile if one shock can wipe you out. 4. Keep learning. The world changes, and you remain free by staying adaptable. 5. Give yourself permission to enjoy life without sabotaging it. Freedom is not misery, it is choice. Section 7, House Edge, and the moment everything gets easier when you are near the ground. Game theory feels relentless. That is why early progress is slow. People misread that slowness. They assume the plan is not working. In reality, the plan is working against a force. The key is to measure the right thing. Do not measure how rich you feel. Measure whether the forces are weakening fewer, less debt, more buffer, more consistency. Those are wins. If you keep stacking wins, you eventually hit house edge. That is the moment where the same habits produce bigger results. You have momentum. Momentum changes everything. Momentum turns discipline into identity. Momentum makes setbacks less lethal. Momentum gives you patience, and patience is where big money is. I want you to imagine two people. They both earn the same income. One has no buffer and high interest debt. The other has a buffer and a simple investing habit. On paper, their paychecks look identical. In reality, they live in different universes. One pays the scarcity tax. One does not. One buys stress. One buys time. The lesson is that small differences in system create massive differences in outcome. That is why I focus on systems, not motivation. In investing, we talk about expected value in life. Your system creates your expected value. A bad system has a negative expected value. A good system has a positive one. Over time, the math dominates. Section 8, the owner's playbook, expanded. Now I will go deeper into the playbook because the details are where people get stuck. Step 1 is to define the minimum life, if you had to. What is the least you could spend for housing, food, transport, and basic bills? Write it down. This number is your survival number. Step 2 is to design cash flow around that survival number. If your fixed bills exceed it, you have a structural problem and you must change the structure. That might mean moving, downsizing, adding roommates, changing cars, or cutting subscriptions. It is not fun, but it is honest. Step 3 is to create a weekly money meeting, 15 minutes, same day every week. You look at balances, bills, and progress. This prevents drift. Drift is the enemy. Step 4 is to build a rule for windfalls. Tax refund, bonus, gift, side gig surge. Decide in advance. For example, 50% to debt, 30% to buffer, 20% to investing. The percentages can change, but the existence of a rule prevents splurges that reset your progress. Step 5 is to define your no list. No payday loans. No buy now, pay later. No carrying a credit card balance. No financing a lifestyle. No impulse investing. Your no list is your shield. Step 6 is to define your yes list. Yes to cooking at home most days. Yes to walking and exercising. Yes to learning. Yes to asking for discounts. Yes to negotiating. Yes to buying assets. Yes to boring investing. Step 7 is to use a two-bucket method for savings. Bucket 1 is the buffer. Bucket 2 is the future. Buffer protects today. Future buys freedom. Keep them separate so you do not raid the future for a small emergency. Step 8 is to deal with the hardest line item, housing. If housing is crushing you, you need a housing plan. That can be moving farther out, sharing space, house hacking, or taking a job in a lower cost area. The point is to restore the gap. Step 9 is to get ruthless about interest. Interest can work for you or against you. When it works against you, it is a silent partner taking your upside. Eliminate the partner. Step 10 is to invest like you will be alive in 30 years. That sounds obvious, but many people invest like they need to be right in 30 days. Time horizon is your advantage. Section 8. Real stories. Real systems. I want to ground this in reality with a few stories. Not to impress you, but to show you that ordinary people can change momentum when they change the system story. A freelancer with irregular income. A freelancer told me the hardest part was irregular income. Some months were great, some months were scary. The chaos created the dopamine trap. We built a base budget and a holding account. On good months, she parked extra cash in the holding account. On lean months, she paid herself a steady paycheck from it. Stability turned her business from stress into strategy. The pattern is always the same. When the system becomes simple and automatic, progress becomes inevitable. Story: a nurse in Omaha. Once met a nurse in Omaha who told me she made decent money but felt trapped. Her problem was not income, it was volatility. Every month she was surprised by the same bills. We built her one-page map. We separated bill money from life money. We automated the buffer. Within 6 months, the overdrafts disappeared. Within a year, she had paid off a high-interest card. When the crisis level dropped, she could finally think about a certification that increased her pay. The pattern is always the same. When the system becomes simple and automatic, progress becomes inevitable. Story: a mechanic with 2 kids. A mechanic with 2 kids told me he worked hard and still could not get ahead. His truck payment was eating his gap. He had financed a lifestyle because everyone around him did. He sold the truck, bought a cheaper vehicle, and used the difference to kill a vampire loan. That move looked like going backward. It was actually the first step toward freedom. 2 years later, he owned his tools outright, had cash reserves, and started a small weekend repair service. The pattern is always the same. When the system becomes simple and automatic, progress becomes inevitable. Story: a couple always fighting about money. A couple told me money was the main source of conflict in their home. They did not have a money problem first. They had a communication problem. So we created a 15-minute weekly meeting with 3 rules: no blame, only facts, and 1 decision per eating. When they stopped surprising each other with spending, trust returned. Once trust returned, they could cooperate on debt payoff and investing, and progress accelerated. The pattern is always the same. When the system becomes simple and automatic, progress becomes inevitable. Story: a single parent under siege. A single parent described money like a siege, and that was the right word. Every month had a new emergency. Every emergency was paid with credit. The first goal was not wealth. It was to stop the siege by building even a tiny reserve. We also found 2 expenses she could renegotiate immediately: insurance and a phone plan. Those small wins created room, and room created the ability to plan. The pattern is always the same. When the system becomes simple and automatic, progress becomes inevitable. Story: a young worker buried in subscriptions. A young worker showed me his bank statement, and it looked like death by 1,000 cuts. Subscriptions, delivery fees, small impulse buys. None of them felt big. We canceled half, set a fixed weekly spending limit, and used cash for 2 weeks to feel the friction. That friction was uncomfortable, and that is why it worked. He used the savings to build a buffer, then started investing $20 a week. The pattern is always the same. When the system becomes simple and automatic, progress becomes inevitable. Section 9. Myths that keep people stuck. Before we close, I want to clear out a few myths. Myths feel comforting, but they keep you stuck. Myth: you must buy every dip or sell every top. Timing the market is a distraction for most investors. You get rich by owning productive assets for a long time. The important thing is staying in the game. Myth: one big decision will fix your finances. Most people do not need a miracle. They need a system that runs every week. One big decision can help, but without habits, the benefits leak away. Small, repeated actions beat rare, heroic actions. Myth: you can outsmart the market with excitement. Excitement is usually a signal of risk, not opportunity. For most people, boring investing wins because it is hard to sabotage. The greatest risk is not the market, it is your behavior. Myth: a side hustle must be perfect to start. Start small, learn by doing. A side stream is built the way a business is built, one customer at a time. Progress creates clarity. Myth: investing can wait until you are debt-free. High-interest debt should be attacked aggressively, but waiting forever to invest is also costly. You can do both in small amounts. Build identity as an investor while you pay down debt. Time matters. Even a small start keeps time on your side. Myth: you need a high income to build wealth. Income helps, but behavior and systems decide whether income turns into assets. I have seen people earn six figures and stay broke because spending rises to match it. The gap is the seed. No gap, no compounding. Myth: being broke is only about willpower. Willpower matters, but forces matter too. Fees, interest, and environment are real. When you design your system, you use willpower once and let automation do the rest. That is smarter than trying to be a hero every day. Myth: budgeting is about punishment. A budget is not punishment. It is a plan. If you do not plan, you are volunteering to be surprised, and surprise is expensive. Planning is what gives you room to enjoy life without fear. Myth: rich people never struggle emotionally. Money removes some problems, but it does not remove the need for discipline. The dopamine trap exists at every income level. It just wears different clothing. Discipline is the price of freedom at any level. Myth: if your friends spend, you must spend. Your friends do not pay your bills, and they do not fund your retirement. You can love people and still say no to their habits. Your plan needs boundaries. Section 10. Questions I hear all the time. I will answer a few questions I hear constantly. These are the points where good plans often fail, so treat them seriously. Should I pay off debt or invest first? Attack high-interest debt aggressively. At the same time, start a tiny automatic investment to build identity and keep time on your side. You are building a system, not choosing a single move. What if I have almost no money left after bills? Then your first job is to change the structure, not to chase investment returns. Reduce the biggest fixed costs, especially housing and transportation, or increase income with a second stream. You cannot optimize a gap that does not exist. What is the simplest way to invest? For most people, a low-cost broad market index fund, purchased automatically, held for a long time. Simple beats complex because it is hard to sabotage. What if I am already in my 40s or 50s? Regret is expensive. Replace regret with rate. Increase savings rate. Reduce fees and automate investing. You still have time for compounding. It may not be as dramatic as starting at 20, but it can still change your life. What if my friends mock me? Then you have learned something valuable about your environment. You do not need to fight them. You need to protect your plan. Find at least one circle where building is normal. How fast can I change momentum? You can feel momentum quickly when fees stop, when a buffer appears, and when debt begins to fall. Real freedom takes longer, but momentum is the proof you are moving in the right direction. Is a budget necessary? A budget is simply a plan for cash flow. Without a plan, your money gets assigned by default. If planning feels restrictive, you are likely trying to plan too much. Start with 1 page and 1 week. What if my partner and I disagree? Start with goals, not rules. Agree on what you want. Stability, a home, freedom, peace. Then set one shared rule, weekly money meeting. Agreement grows when facts replace surprises. How do I stop impulse spending? Remove triggers and add friction. Delete apps, remove saved cards, and use the 24-hour rule. Then replace the habit with a forward-moving reward. Exercise, learning, building, or creating. What if my income is irregular? Create a holding account. On good months, park cash. On lean months, pay yourself a steady amount. Stability reduces the dopamine trap and makes planning possible. What if I fail again? Then you adjust the system. Failure is feedback. It is not identity. Make the plan smaller and more automatic. Small wins restore momentum. What if I want to enjoy life now? You should. The goal is not misery. The goal is control schedule, enjoyment, and keep it inside the plan. Joy is fine. Chaos is the enemy. Section 11. A simple checklist you can run every week if you do not know what to do next. Run this checklist. It looks simple because it is simple as what you can repeat. Loan. Did my bills get paid on time this week? 2. Did I avoid new high-interest debt? 3. Did I add anything, even a little, to my buffer? 4. Did I make at least one extra payment toward vampire debt? 5. Did I invest automatically, even if the amount was small? 6. Did I cook most of my meals and avoid the delivery trap? 7. Did I get sleep and some movement so stress does not drive spending? 8. Did I spend time learning a skill that increases my value? 9. Did I review my bank and card transactions for 5 minutes? 10. Did I say no to at least one impulse that would have hurt me later? Now a monthly checklist. Loan, track net worth, assets minus liabilities. Write the number down. 2. Raise your automatic transfers by a small amount. If income rose. 3. Cancel anything you are not using. 4. Call one provider and ask for a better rate. 5. Review subscriptions and recurring charges. 6. Review insurance once a year and shop it if needed. 7. Review your investing allocation only a few times a year. Do not turn it into entertainment. A plan you can repeat is more valuable than a plan that looks smart on paper. Section 9. The 90-day execution plan and scripts appendix. A 90-day plan to break the loop. I am going to outline 90 days because 90 days is long enough to change momentum and short enough to feel real. Day 1 to day 7. Get clarity and stop the bleeding. Write down every bill and every debt. Call the companies. Ask for hardship programs. Ask for lower rates. Ask for payment plans. You will be surprised how often asking works. Cancel subscriptions you forgot existed. If you are not willing to cancel, you are not yet serious. That sounds harsh. But it is true. Cook at home for 7 days. Not forever. You are proving to yourself that you can control the easiest leak. Day 8 to day 21. Build the buffer. Open a separate savings account. Name it buffer. Set an automatic transfer the day after payday. Start with an amount that you will not break. $10 is acceptable. You can raise it later. During this period, sell one thing you do not use. The point is not the money. The point is evidence that you can create cash on purpose. Day 22 to day 45, kill the vampire, choose your target debt. High interest first is mathematically best. Small balance first is psychologically easier. Choose the method you will actually do. Every week, make one extra payment, even if you are building the identity of a finisher. Day 46 to day 70, increase earning power. Pick one skill. Commit to 45 minutes a day. No negotiation. 45 minutes is enough to progress and small enough to be realistic. If your skill is sales, practice calls. If it is writing, publish daily. If it is a trade, find a course and complete modules. If it is data, build small projects. Skills grow like compound interest. Day 71 to day 90, automate ownership. If you have a retirement plan, contribute enough to capture any match. If you do not, open a simple brokerage account and set a recurring buy into a broad index fund. Do not check the price daily. Your goal is ownership, not entertainment. At Day 90 Review. What improved, what failed, what needs to be simplified. Then run another 90 days with small adjustments. Appendix scripts you can use when life pushes back, when a friend pressures you to spend. I am on a plan this quarter, I can join. But I am keeping it simple. When you negotiate a bill, I have been a customer for years. I want to pay. What can you do to lower the rate or extend the term so I can stay current? When you negotiate a raise, here is what I accomplished. Here is the value it created. Here is the market rate. I would like to discuss adjusting my pay to match the value. When you feel the dopamine urge, I am allowed to want this, but I do not have to buy it today. I will write it down and revisit tomorrow. When you get discouraged, momentum is built in boring ways. I only need to do the next small action. The casino offers excitement. Ownership offers freedom. Once you taste freedom, the excitement stops being tempting. Section 10. Final word. If you only remember one thing, remember this: the world will not rescue your financial life. The world will sell you comfort and call it freedom. Freedom is built in small, boring, repeated actions that move you from fragility to resilience, from linear income to ownership, and from stress to calm. I cannot promise the journey is easy, but I can promise it is clearer when you see the forces. Once you see game theory, you stop blaming yourself for every slip, and you start designing around it. Design wins, systems win, and over time, the person with a system becomes the person with options. That is the whole point. And let me be blunt. If you do nothing, nothing changes. The forces win by default. But if you build a system, even a small one, and you protect it, you can change the trajectory faster than you think. That is the difference between people who stay trapped and people who break out.